Hello everybody and welcome to the Tortoise channel. Very happy to have you join us. And today's video is going to be on Lululemon. I know many of you guys have been asking me to give you an update on my holding, one of my holdings, which is definitely Lululemon, as you all know. And so I want to tell you about that. I want to break down whether I think the moat has been disrupted, right? Whether the moat has been penetrated, or if I still think this is going to be a key theme going into this year, so 2026. Okay, before I delve deeper into today's video, once again, if you haven't registered for the upcoming webinar, just to make sure that you do, because it's completely free and it's jam-packed with investment knowledge that I have acquired over many years of investing. So I do think this can be very helpful for you guys if you want to learn more about the process that we use. If for some reason you cannot attend on the 22nd of January at 4 p.m. London time, then no problem at all, because we're going to have a live event here on YouTube at the end of the month. So you can see this is on the January 31st, and so you can ask me anything, because I really like the experience that we had initially. So in the first video, and I'm eager to do at least one of them, one of these every month at the end of every month. So if you can just join this one here, and as I stress out in the as I stressed out in the video before, I also left a comment right here asking you guys to mention any companies that you would like me to address, that you would like me to do a deep dive on. Okay, and then what I will do is I will pick the 2 to 3 most requested names and do a thorough analysis of each. Okay, so if you haven't done that, by all means, just do it, because I mean, what does it cost you? And you can gain a lot of value from it. Okay, so cool, guys. Now let's discuss important things. Okay, as always, I've put everything together in a Word document, just I pulled together important info from a report that I saw on Lululemon, and this is straight out of Interactive Brokers, my Interactive Brokers account, because it's a report that was issued by Morningstar. Okay, so I just summarized everything, just refined it, and just did my best to convey the most important things. Okay, so you can see, for example, for those of you who don't know, and for those of you that are watching this video and are new to the channel, welcome. I always use Interactive Brokers to execute all of our transactions. Okay, but I do use I do use eToro with many clients because it's simpler to use. And that's the one that I think so from a visual standpoint, yeah, right, if we are looking at charts and all of that, I think that one is easier. However, we use Interactive Brokers to execute all of our portfolio transactions. Okay, and if you do have Interactive Brokers, then you know that if you click on one of your holdings and you come to the Fundamentals tab, you will see that Morningstar will give the company a fair value estimate. In the case of Lululemon, which currently trades at $202 per share, they believe the fair value is around 295, which represents substantial upside from current levels. But I never really pay attention to the fair value estimates, because I know that my assumptions are always more conservative. And the reason is, number one, analysts by and large tend to be more optimistic. That's one thing. Number two, they typically use the WACC when they do an analysis model, right? So the WACC is the weighted average cost of capital, and for well-established companies like Lulu and in developed countries, then the WACC is typically around 9 to 10%. That's usually what many investors use, right? The discount rate that they use in their models, but I always use 15%. Okay, and so my fair value estimates will always be lower, because I'm discounting the future cash flows at a higher rate, if that makes sense. Okay, I'm more conservative here because I want to double my money every 4 to 5 years, as you already know. But what I really like about this is, if you expand this tab, then you can see you can see exact how they break down this investment thesis. So they start with the analyst note, the business strategy and outlook, the economic mode trend, and you can just download the full report, which is exactly what I did. And this is where we have all the key information. Okay, look, they discuss the business strategy and outlook, and you can see that this guy is the one covering this stock. Okay, look, this is quite recent, December 16th. So he discusses the business strategy and outlook. Then he breaks down what bulls and what bears are saying, economic mode. Moving on to moving on to fair value and profit drivers in risk and uncertainty. Okay, and also capital allocation. And so what I did after reading through the whole report, I just decided to do what I normally do, as I already mentioned, and I will walk you through that right now. Okay, let me go here. Okay, let me just minimize this, and now let me pull this up. So bear with me, because I think there is just so there the data in this report is so compelling that I just look, I think it's great that we're going to be able to cover everything. So bear with me as I just walk you through the main findings. Okay, so it's a bit long, but however, if you are a Lululemon investor or if you are interested in the stock, then please just continue to watch this video, because I think it's very insightful, very educational. And if you are not even investing in this company, then it may be, look, you may find it at the end of this video that, wow, this is a company I would like to invest in, right? It meets it meets my meaning criteria. It aligns with my values, whatever. Okay. So in terms of business strategy and outlook, you can see that his update is from December 16, 2005. And what does Morningstar think? We think Lululemon has a solid plan to expand its product assortment and geographic reach while building its core business. While many firms are looking to compete in athleisure, we believe Lululemon will continue to achieve premium pricing due to brand's popularity and the styling and quality of its products. I'm not sure how many of you guys watching this channel, certainly some of my community members are fans of Lululemon. They love the fabrics, they love how it sits, how it feels. And so this well goes to show that they can so they can price their products at the premium without losing customers, right? Because they love the product. Lululemon is currently searching for a new CEO, and as North America sales have slowed significantly. So the new CEO, I think, Calvin McDonald, which was the former CEO, is to step down at the end of this month, I believe, and the board is already on the lookout for a new CEO, but we will talk more about that ahead. Okay, so under its new leadership, under the new leadership, right, under the leadership of the upcoming CEO, we expect a renewed emphasis on driving sales growth through the 5-year plan that was laid out at April 22 investor event. Its three primary priorities are product innovation, e-commerce, and international expansion. And one of the things that really attracted me to Lululemon was the fact that they previously delivered on these plans. Okay, still under Calvin McDonald, which I believe has done a fantastic job as the CEO of Lululemon. All right. So if you go back to the previous earnings calls, you can see that they laid out plans and they execute on them, right? And that is very important. We think product innovation is critical, as many competitors sell women's leggings and other athleisure items or of similar quality. Thus, Lululemon must introduce new fabrics and technology to hold share in this critical category. The firm also plans to add to its men's assortment by 24% of 2024 revenue and expand its nascent athletic footwear line. While we believe these categories fit the brand, they also bring it to direct competition with athletic apparel firms like Nike. All right, we see an opportunity for Lulu to expand outside its home region. Sales outside the Americas accounted for just 25% of 2024's total. but this was up from 16% just 2 years prior. Look how fast international sales are growing. Very nice. We believe Lululemon is building its brand overseas and has a large opportunity for new stores and larger online sales in China, the second largest activewear market, okay, after the United States. We project the firm will have more than 170 stores in mainland China by the end of 2025. This actually happened, of course, and this represents an increase of about 75% from the end of 2022. In 2034, we forecast sales outside the Americas will exceed 10 billion, up from 2.7 billion in 24, and account for nearly half its total sales. Okay, so sales outside the Americas are growing explosively. Yeah, right. There's no denying, and I've been covering that over the past, over the last. I covered that in the last Lululemon, in the last video that I did on Lululemon, and immediately after the earnings report as well. Okay, so that is representing a larger share of their portfolio, but still, many of their sales are, as you know, are still fully dependent on, are still heavily tied into the not into the North American and the Canadian markets. Like others in its space, Lulu outsources its production to factories in Asia, thus it's exposed to higher tariffs on US imports. Tariffs are expected to have a 4-point negative impact on the gross margin in 2025. Over time, we think the company can offset some, but not all, of the added costs with price increases and supply chain changes. So what exactly are bulls saying? Despite having many rivals, Lulu's productivity stands out in the sportswear space. Its sales per square foot were nearly 1,600 in 2024, and its operating margins are around 20%. Okay, Lululemon has a big opportunity in mainland China, which accounted for just 13% of its 2024 sales. China is already the second largest sportswear market in the world, and Lulu is often credited with the development of athleisure, a major change in how people dress. It's one of the few strong areas in the low growth apparel industry. So they have the first mover advantage. For example, other companies in our portfolio um, um, also benefit from this first mover advantage, right? So PayPal is one of them. Lululemon, as we are discussing right now, is another one. Evolution AB is also another one, right? So this typically gives them an advantage, but by all means, don't just rely on that fact. The company needs to continue to innovate, and that is certainly the case with Lululemon. So, what do bears say? Competition is ubiquitous. In all of its key apparel categories, the firm faces challenges for firms like Vuori, Alo Yoga, and Nike. Is improving its competitive through its schemes. Nike is improving its competitiveness through its schemes partnership. Lululemon sales growth in the US has slowed due to competitive threats and its own missteps. Management missteps have been important, right? And in fact, I like the fact that the management team really addressed that. They didn't shy away from letting the shareholders know. They realized that they rested on their laurels. They forgot to innovate in the Americas, and customers got bored with their products. They stopped visiting their stores, right? So management missteps. Adding to its problems, higher US tariffs are depressing its gross margins. After years of stability, Lulu has had several management changes. The firm is searching for a new CEO. So all these risks are warranted, okay? And I largely agree with them. Okay. So what about the economic moat? Does the company have a moat? What do Morningstar say? They say our narrow moat rating on Lulu is based on an intangible brand asset. While the firm operates in an industry with many participants and low barriers to entry, its brilliant performance through challenges like COVID, inflation, and the general slowdown in activewear spending suggests that its brand is strong enough to outperform peers consistently. Although its merchandise is mass produced, Lulu's prices productivity products and selling model separated from traditional sportswear firms. Okay? Very, very important. Rather than being just a fad. So for those of you who think like Lulu may be a fad, I completely disagree. So I agree with Morningstar on this subject. Rather than being just a fad, we believe that Lulu has permanently changed how many people regularly dress. For these reasons, we think a narrow moat is warranted. Lulu is often credited as the creator of the athleisure apparel trend and has grown massively to be a market leader in North America. You can see that in 2025, the firm had 6.3% share of the market, right? Second only to wide mode Nike, which is indicative of Lululemon's superior growth as compared with many peers. And you can see that its share of this market was less than 3% as recently as 2017. Okay. And it came at the expense of Nike, narrow mode Adidas, and no mode Under Armour and others. So the company has had incredible growth outside of North America. Just about 10 years after opening its first stores in Europe and Asia, the firm recorded more than 2.6 billion in sales outside of North America in 2024, providing support for our narrow moat rating. Lulu's adjusted returns on invested capital, including goodwill, have averaged 39% over the past 10 years, which is far above our 10% estimated weighted average cost of capital and very high for any apparel retailer or manufacturer. Okay, so let me just plug this in as I'm running out of battery, and then I took the liberty. I'm going to interrupt this document here right now, right? Because I want to show you something. I just went to stock analysis and downloaded a list of all Lululemon's main competitors. And so the goal what I want to do right now is to just see how they stack against how they stack up against each other. Okay, and so if I go here, look at that. We can see where is it? Right here. Okay, cool. So if I do this, let me do this right here. Okay, bear with me 1 second. Let's just filter by color. These are their main publicly listed competitors. And you can see that Lululemon is, oh, damn, hold on a second. Okay, so I want, no, let me go back. Okay, and now what we're going to do is, let's do this. Filter by color. Okay, and now we can highlight this in yellow so you guys understand the difference. Okay, look how cool that is. So look at that. So we have Nike, and by the way, these are all they are sorted via they are sorted by market cap, right? And look, Nike, Adidas, Lululemon, Deckers, The Gap, VF Corporation, Crocs, American Eagle Outfitters, Puma, and Under Armour. You will know many, if not all, of these companies. But now let's have a look at the metrics that I want you guys to focus on. Okay, so look at this. Look at Royce. So when it comes to Royce, these are recent. So despite all the headwinds, right? Headwinds affected, especially the macro headwinds, ended up hitting all of these companies, but they hit some of them. They hit some of them well, stronger than others, heavier than others. Okay, so you can see, for example, Lululemon's Royce as hovers around 25.93%, call it 26, and you can see that only one company boosts a higher Royce than Lululemon, and that is Deckers. Okay, Deckers, which is not really a direct competitor, but still I keep it here so you guys can see. Okay, look at Roy. Lululemon 41, only next to Deckers. What's even more staggering is compare the Royce of Nike, the first one, to that of Lululemon, And look at Adidas, 10%. Look at Lululemon. So Lululemon's ROIC is much greater. And what you know is that the ROIC, according to what they are saying, Morningstar right here, it's far of 39% over the past 10 years, far above our 10% estimated weighted average cost of capital. What does that mean? It's the economic spread. If you do 39 minus 10, you get 29%. What this means, guys, you get 29. What this means is that the company generates a lot more on its invested capital than its costs to fund it. Okay, so and by doing so, the company creates a lot of value, right? And the value that the company creates is far greater than that is created by its largest competitors. Okay, very, very good. So it's the economic spread, the difference between ROIs and the WACC, the weighted average cost of capital. Cool. Let's go back here and look at the ROIs over the 5 years and look at this consistency. So for Lulu has been around 25%, as you can see, and look at that. Only down, it's even greater. The ROIs better than that of Deckers, and only lagging behind Crocs, as you can see right here as well. Okay, cool. So what about gross margins? Look at that, 58%. These are current, guys. I mean, this is just current levels. In fact, on a quarterly basis, this number has come down because, and you will see that if I show you this right here, stock analysis. Let's do this, Lululemon. So if I go here to the financials, and if I go to the quarterly, you can see that where is this? Look at that. Gross margin has come down exactly on the back of profit, on the back of tariffs. They used to be 58. Okay, so they are 58 on a trailing 12 months, but they have come down because of the tariffs. Okay, but what you can see is that the numbers look very solid. Even if you have, for example, 55%, number one, all the companies' gross margins have also come down, right? Certainly most of them, because they were all impacted by tariffs, despite not being impacted equally. But still, even at 55, look how compelling that is, guys. Amazing, right? And then with operating margin, we saw more or less the same. So here the trailing 12 months is 22. However, if we look at the quarterly, it has come down to about 70%. Okay? So bear that in mind, 17%, which is still very good. So what you can see is that even against the backdrop of tariffs and management missteps, the company boosts some of the most attractive margins in the space, and that is something that really drew me into this investment. Look at free cash flow margins, okay, but this I don't weigh heavily on free cash flow margins because I know the company has been ramping up capex, which can distort the free cash flow figures. Okay, profit margins, this is important. Okay, look at profit margins. So they are they came down from about 14.69% to about 12%, which is significant, but still very attractive when you compare it to other players. Look at Nike, 5.43% on a trailing 12-month basis, and look at Adidas. Okay, I mean seriously, I mean it's just what it is. And in terms of debt levels, look at that. As you probably know, Lululemon, look at this. The company has practically in fact, they have no long-term debt unless you consider the leases as debt. If you do, then you can see that it would only take them less than 1 year to pay all the debt from, to pay all the debt from earnings before interest, tax, depreciation, and amortization. And you can see that it would take them less than 2 years to pay all the debt from free cash flows. So they have a very healthy balance sheet, okay, which is important. And sure enough, look at that, the interest coverage ratio they don't have. Yeah, out of all these companies, they are the ones who don't have. They are the only ones who have no interest coverage because they don't have long-term debt. They have leases. Okay, look at the revenue growth over the last 5 years, 22.16%. Yeah, earnings per share growth 5 years, 27%. This is the PE ratio, the current PE ratio, 13.94. But look at the PE over the next 5 years. And the forward PE is only 16. Okay. So you can see, however, that a PE of 13 is in line with other companies. And look at Nike, almost 40, and the fundamentals are way weaker compared to those of Lulu. Okay, even though the moat here is wider because they are more established, and so on and forth. Okay, but still very, very good. So yes, the multiple has expanded on Lulu, but I still think it's a compelling investment at today's prices if the company can continue to execute on its strategy. And so forward PE, the PEG ratio, the price to free cash flow, then we have the yields, and this is the main things that I want to cover with you guys. Okay, so I hope you managed to gain value from it. Now let's continue. At an annual average. At an annual average of 31%, we forecast adjusted ROIs, including goodwill, will greatly exceed its WACC over the next 10 years as well. This is the forecast. This is what they estimate, which if this is the case, then indeed a Lululemon can continue to unlock a lot of shareholder value going forward. The firm's returns benefit from its asset-light model since its production is outsourced, but this is true throughout the industry. The firm has consistently performed strongly despite the presence of many rivals and copycats, so this is not new. We think Lululemon's significant control over its sales provides an advantage. Guys, pay attention to that because this is another key factor that made me invest in Lululemon as opposed to Nike at the time. Excuse me. As opposed to Nike at the time, okay? Let me show you this here. Look, unlike many competitors with large wholesale operations, Lululemon generates less than 10% of its sales through third-party retailers, mostly specialty yoga shops and the like. Instead, the company mainly sells its merchandise through company-owned fully priced physical stores and e-commerce. The company's model allows for a control over pricing, discounting, expenses, product assortment, and marketing. Okay, so competitors who sell through partners like Nike and Adidas lack this level of control and must share margin with retailers. What's more, competing brands may lose their integrity if their product is discounted or sold through struggling stores. So I like the fact that Lululemon has a significant control over those sales. Whenever you can see that many third-party retailers sell Nike shoes, and you don't, because they do that. Many times it can be that the company, so Nike, doesn't have control over discounting. Yeah, the same way they don't have control over the customer experience, the interaction, and that's why I like the business model of Lululemon a lot more. Okay, so supporting our narrow moat rating, the combination of direct selling and premium pricing allows Lulu to achieve stronger pricing and gross margins. Over the past 4 years, the firm's gross margins have averaged 58%, well above peers 45-50% do, in part due to its superior pricing power. Now, this has come down, as you guys know, exactly on because of, against the backdrop of tariffs that have eaten away at their margins. However, many of its competitors were also impacted. I want to point that out. It's not just Lululemon's margins, gross margins that have suffered. Okay, the other ones have suffered too. In part due to its superior pricing power, the quality of Lulu's products allows the brand to remain popular and achieve premium prices. To support innovation, the firm consistently develops new fabrics. Its apparel is designed to be bacteria and smell resistant, feel great, and survive many washes. The material in its apparel is significantly more expensive than in traditional athletic shirts and pants, partly accounting for its relatively high pricing. So whenever you hear people say, "Oh, it's so expensive," yeah, but you are paying for quality. You are buying quality, right? It's just how it is, how it works. Many of its competitors sell apparel with cheaper materials at lower price points. Yeah, of course, if they are shitty quality, makes sense. We think Lululemon protects the integrity of its brand by selling only high quality apparel, and it has continued to grow and improve margins despite the availability of many similar products. So we want to avoid brand dilution at all costs and avoid the mistake that Nike made, which cost them the stock, which cost them a lot, right? So the stock has come down a lot, partly because of missteps as well. They started discounting products, and it became they ended up diluting the brand in the process in the process. From its origins as a women's yoga brand, Lulu has expanded into men's clothing over the past decade. Menswear accounted for 24% of its 2024 sales. In contrast, some of its main athleisure competitors sell almost exclusively to women. Although male participation in yoga is increasing, most men purchase Lululemon gear for running. While the men's running category is very crowded, we still think the high quality of the company's fabrics, styling, and the popularity of its brand has attracted consumers. Like its women's merchandise, its men's apparel retails at premium prices. Okay, and now we are nearing the end. As evidence of its brand strength, Lulu generates strong sales even though it only spends, guys, look at this. They generate strong sales even though it only spends about 4.5 to 5% of its sales on advertising. For comparison, most of its competitors, like Nike, right, spend 8% to 13% of their annual revenue on marketing. In contrast to Nike, Adidas, and others, Lulu's online and TV advertising is limited. You right? Does that make sense? How many of us see like advertising, see like advertising on TV for how many of us see Lululemon's products advertised on TV, right? I mean, I don't remember seeing that, yeah, but I do remember seeing Adidas in the Nike advertising all the time. Yes, and that ties into what we are reading here right now. And its athletic sponsorships are small but growing. This is important, growing. Instead, the firm engages in more personal forms of marketing, such as through seemingly ubiquitous reusable shopping bags, and by offering yoga and fitness classes in its stores. In fact, this is part of what made them famous as well. You have many fitness instructors. Many, they are called the ambassadors that advertise, that promote the brand while having in-person interactions with customers. Okay, so these popular classes increase customer goodwill and encourage loyal customers to visit their stores. Lulu also sponsors yoga and fitness instructors, here we go, known as ambassadors, who promote the brand. We believe the firm has local connections to its customer base that other apparel retailers do not possess. And so, look at that. Lulu's they generate 75% of its 2024 sales in the Americas, which is still right quite significant, but its international sales are growing rapidly. In mainland China, Lululemon has many years of potential growth, as it only has about 170 stores in the region, while rivals like Nike and Adidas have several thousand of locations. So the growth there is still in its early innings, which is something that I love. Okay. The potential for expansion is large, not only in China, right? So as the company still has 20 or fewer stores in such countries as the UK, Germany, South Korea, and Japan. As in its home market, Lulu achieves high prices for its products. I know that because I'm in London, you only see 4 or 5 Lululemon stores across the city, and they still charge premiums. They charge a premium pricing. So yeah, so they charge a premium for the products, right? So achieves high prices for its products in its international stores. For example, in the UK, many of its bottoms are priced above 100 per unit. Yeah, I corroborate that. Thus, we think it will hold its operating margins above 20% in Europe and Asia Pacific, even as its geographic focus shifts. We forecast its sales in the Americas will fall to 51% of its total sales in about 10 years, as its international growth exceeds that of more mature North America market. Why is this significant? Because it creates more diversification. Right now, Lululemon is still heavily dependent on the Americas, which includes the North America and Canada. But over time, we will see that dependency decrease as they grow internationally. Okay, and now in terms of risk and uncertainty, they assign a high uncertainty rating to Lululemon. Okay, they assign a high uncertainty rating to Lululemon. The firm, like many others, is exposed to tariffs as most of its sales are generated by imports to the US from factories in Asia. In addition, sales could be reduced if tariffs lead to weakening economic conditions in North America or China. Competition is also eating up, right, in core athleisure category. Although competition is nothing new, the reality is that brands like Alo Yoga and Vuori have recently had a noticeable negative effect on Lululemon's US sales. And thus, Lululemon depends on the continuation of the athleisure trend that it helped create. While we believe athleisure is not a fad, fashion trends can change quickly, and this is why many wise investors just decide to stay away from companies in the fashion space because they don't know, they can't understand how durable the competitive advantage of these companies is, exactly because fashion trends come and go. Okay, I understand that, but I think Lululemon's brand reputation is quite sticky among customers, and I think they will be able to turn the business around. Also, many firms from multinationals to tiny startups sell low-priced leggings. Lululemon must continuously introduce innovative products to maintain its price leadership and remain popular. But as specific styles of clothing cannot be patented, the firm has limited ability to prevent copycats. It's a reality. Okay, to meet expectations, Lulu will need to generate significant growth in regions where it has limited history and brand recognition. Okay, this is important because they're going to have to do that to grow internationally, to expand the business. They have to grow internationally, as we discussed, and in many regions, they don't have the same expertise as they do in the Americas. In 2024, generated just 25% of its sales outside the Americas. However, the firm has aggressive expansion plans, as we already discussed. There is also a risk that the company could fail to find a strong candidate, a strong replacement for the current CEO. Okay, even though I don't think that will happen, not least because, as you know, as I discussed already in a previous video, the activist investor Elliott Management stepped in, and it is rumored that they are the ones spearheading the search for a new CEO. Okay, whether that is true or not, I cannot tell. In terms of capital allocation, we assign an exemplary capital allocation rating to Lulu. The company's 10-year average annual ROIC return of 16% is impressive and exceeds the 13% average annual return of the apparel retail sector of the Morningstar US Market Total Return Index over the same period. Now, they have experienced growth as its yearly sales have increased to 11 billion from 41 million in 2004. Lululemon's consistent profitability and free cash flow have allowed it to grow without any debt. That's why, if you come here, for example, to the balance sheet and you flip it to trailing 12 months, you can see if you go to the long-term debt, I think so if you go to the long-term debt, look, they only have long-term leases. But long-term leases are not debt per se, right? Because they don't have to pay interest. It's not bank loans. That is there is a completely different kind of debt, okay? And so they are debt-free, essentially. And that is why if I go here to stock analysis, they also mention that. Look, financial health, they mention debt-free. Okay, pretty cool. So let's continue. Over the past 10 years, okay, over the past 10 years, the company has generated an annual average of about 575 million in free cash flow to the firm, while spending 360 million per year in capex. Much of the investment has gone into new stores and expanded e-commerce, which we think has created significant value. What are they saying here? They are saying that a lot of that capex, so a lot of the money that was allocated toward capex is geared towards growth capex. So they were spending a lot more on growing the business than on maintaining the current operations, which would be maintenance capex, right? So even as it has grown, adjusted ROIC, including goodwill, has largely remained in the 35 to 40% range, and operating margins have been around 20%. So in future years, we expect Lulu to continue to open new stores and increase its digital sales while maintaining high operating margins in ROIC. Very important. We estimate long-term margins in the low 20s and yearly ROICs of about 31%, and we expect Lulu to remain debt-free and generate significant cash flows. They also say Lulu has been an aggressive buyer of its shares, having repurchased about $5 billion worth of shares since the beginning of 2017. And in fact, if I show you this right here, let's go here to our income statement, and let's go to the trailing 12 months. And if I show you diluted shares outstanding, you can see that since 2016 they have been reduced by about 14%. And if I zoom in on this, since 2020 alone, they have been reduced by almost 10%. Okay, very, very good. Love that. Cool. So let's continue. Moreover, the firm recently added $1 billion to its existing share repurchase authorization, which brought the current total to $1.6 billion. At times, the company has completed buybacks at high valuations, which we don't like. Okay, but however, in our view, the recent decline in its share price has made buybacks more favorable for stockholders. And Lululemon has grown organically. Okay, very important, and we expect this will continue to be the case. So it's not like they are going to do a lot of acquisitions. They expect them to continue to grow organically, and so do I. We anticipate it will continue to expand geographically, introduce new products, and build digital capabilities. The firm has had some missteps, but has generally been very successful with its internal investments. Yeah, which, of course, is a testament to their high ROIC levels. And we think it will continue to be so. Okay, so guys, this is what I wanted to show you. Just gave you a full deep dive into the company's key fundamentals, as discussed in the Morningstar report on the company. And what I wanted to show you right here is from just doing some quick math right here. So, for example, let's go here to our stock analysis tool. And for us, let's say we want to double our money over the next 5 years, which is definitely the case. Okay. And first, let's go here to the financials. Let's go here to the metrics, and let's see the net margin. You can see that the average, going back to 2014, let's go back to 2017 actually, you can see that the average net margin has been around 13.95%. So let's call it 13%. Okay, let's call it 13%. So let's say I want to double my money in the next 5 years. And if I go here to the overview, this is the market cap. Okay, so let's do the quick math here. Let's do, so 323,068 multiplied by 2, that gives us about 46,136 in market cap, right? And if we divide this by 20, which is the PE that I'm assuming the company will have in 5 years, right? Because I think the PE will expand to 20. It's still a premium company, and it will continue to be. So I will assign it a PE of 20. Then if this happens, this means you're going to produce net income of around 2 billion, of around 2,306 million. Okay. Now let's assume in 10 years the net margin will be around 13% of 13%, right? So if we divide this by 13%, that means in 5 years the company will need to have revenues of around 17.744 billion. Right now, look where revenues are, 11.07 billion. So let's do the math here. if I go here to our compound growth calculator, 11,007. So let's put here, look, 11,007, and we want this in 5 years, and we're going to put our assumption right here. And you can see that for this to happen, you can see that the company would have to grow revenues by about 10% per year over the next 5 years. And so the assumptions that we want to make is, do we think this makes sense? Do we think Lululemon will indeed be able to grow revenues at about 10%? And if that is the case, then it means we should be able to double our money in at least 5 years. And my thesis is that even at current levels, Lululemon is still represents a buying opportunity. In fact, if I go here to total revenue, you can see that going back to 2017, total revenue has compounded by about 20%. Even more recently, for example, to 2021, you can see that revenues have compounded by about 19.42%. So I think 10% is rather conservative, and that really means that I think I have a significant margin of safety still, even though I bought the company at a much lower price level, as you know. Guys, I mean, this is all I wanted to discuss. I know that this video is already well extended, so apologies, but I hope it was insightful. And I just tried to explain much of my thesis with this on this company. And let me know in the comments below if you found this insightful. If so, smash the like button and stay tuned for more, guys. Let's smash it this year.